Now, let's look at comparing these three strategies using real stock prices. Let's use the real history because the last example I used fixed growth and fixed dividend was used. So this time I'm using the real S&P 500 price of the last 96 years with the real annual gain dividend. And it's from 1928 to 2023. So this is kind of a pessimistic number because 1928 is at the top of the stock market right before the Great Depression. So it'll drop, and after many years, it'll come back. And for every year's gain, I can order it. So for every year's gain, I can order it differently so that it's like you can treat the different gain. You can think of the different gain and the loss happens in a different order. So you can have, it's like multi-universe, you can have different history. And the analysis is in this file. Let's go look at it. Okay, so this is with the real price. And you go to the last one, and that's the real price here. I can order it by the year. Oops. Order it by the year from 1928 to 2023. And the gain, the total annualized gain for all these years, if you get the gain without with dividend but no tax, annualized gain is 9.6%. But with tax, you get 9.1% with assuming dividend reinvest. So you look at the price gain in 1928, it increased by a lot, and then it drops so much in the next many years, and the increase and drop. So those are real numbers and dividend. This is at almost the bottom of the Great Depression, and the dividend is very high. So reinvest dividend is very good for your stock portfolio. I also ended this random, so I could order it randomly, and now the year is random. So I get a different history. It's still real, but different order. So drop a little bit, increase, drop, drop, and I can order it again. So it's another random order, increase, drop, and so on. Okay, so now let's first use the real history. And let's compare sell, borrow, box, the same amount of fixed amount. So let's start with 2%. So when you sell with, start with 2% and you sell in the real history, because the first several years, it dropped too much. It's quickly dropped below the starting $1 million. You look at the amount. And finally, after like 26, 27 years, it started coming back up. And eventually grows quite good. 1 million becomes $267 million. Let's look at the borrow method. The borrow, initially, there's no leverage because dividend is high. You only need to use dividend. But after some time, you have to start borrowing money to satisfy the withdrawal amount because you are withdrawing 4, 5, 4% of your portfolio. It's already not a safe number. You keep going, the leverage continue to increase until 22%. And finally we get into bull market and we get enough dividend to pay off the debt. So eventually we get $570 million compared to sell $267 million. So borrow, you took some risk, you get a lot more money, more than double the money. Let's look at the box. So again, you start with a good amount, but it keeps dropping and you get some leverage. finally, you get $526 million, very close to $570 million. And the max leverage of Box is 12%, 13%. For Borrow, the max leverage is 22%. So Box get much lower leverage compared to Borrow. Now let's look at 3%. So when we were not using the real price, 3% worked fine before. So here, with 3%, we were wiped out. We withdraw too much. So the withdrawal proportion keep increasing. Although the stock market keep decreasing, you still increase your withdrawal by 3% every year. Not good. So after about 20 years, all gone. With the Borrow, after 16 years, it's gone. It's just too much. 3% is too much in the real market if you go back and retire $1 million in 1928, if you withdraw this much. Okay. So, and with Box, leave it a little longer, similar to sell. So it still died. So there's no magic. Box is not a magic. If you withdraw too much money, you will get wiped out. So this is withdrawing fixed amount, these three methods. Now, let's look at withdrawing a proportion. So when you withdraw a proportion, let's start with 2%. Sell 2%. Start with $1 million here. And in the end, if you do the sell method, becomes 300 million. With Borrow, becomes 386 million. And the leverage, 30%. Leverage can be up to 30%, not safe. Let's go to Box. So 375 million compared to 386, close. And the leverage at most 18%. Compared to Borrow, 30%. 18% is much safer. So Box, again, get close to the Borrow's amount using the Borrow method with much less risk. What about 3%? Okay, sell, it goes fine because this 3% is self-adjustable. If stock market drop, your withdrawal amount also drop. So you withdraw $41,000 a year, but then it dropped down to $12,000 a year. So this is self-adaptive and make it much safer to do. So in the end, your portfolio grew to 85 million. And let's look at Borrow. Borrow died. Borrow died after 80 years. Why? 83, 84. So there must be a very big drop. There's a, 82. There's a big drop in 2008. That killed it. So that big drop with this kind of leverage, you're done. Okay. So with Box, it keep growing, okay, because its leverage is not that high. On the year where we have a big drop, leverage increased from 22% to 48%, but we survived. So we collected $160 million in the end, and we were not wiped out. Look at sell, 85, Box, 162, so not bad. And we can actually look at alternative history here. So Borrow lived for 80 years, Box lived well. Let's change history. I will reorder this. Okay. So it started with some drop and so on. Okay, let's look at the number. With the Borrow, it also died after 72 years. with box. Okay, box again survived. So box is robust. It's not only survived, the leverage is not too bad, 17% max. After 70 years, 16% max. Okay, so actually not bad. But borrow, because the leverage keeps increasing, it died. So withdraw 3% died. You can do this again. Okay, it's another history. And every history is unique. When you borrow, died again after 60 years. Box lived again. Okay, so I'll stop here for the analysis. Let's go to summary. So using real price, it is more realistic, and you can see with the real market in a big bear market, you can really get wiped out if your leverage is too high or if you withdraw too much money. And you can reorder to get different history to find out how robust is your method. And because we cannot predict the future, and even the past cannot predict the future, a more robust method is very important. And if your account doesn't get wiped out, sell is the safest because it only sell. It doesn't give you, use leverage. But the gain also is very low. Borrow give you the best gain if it doesn't get wiped out, but you're taking a lot of risk. And box is usually the winner with good trade-off. It has about half or sometimes less than half of the leverage compared to the borrow method. And the gain is close to the borrow method. So the summary of all these three methods is that box is the best method. It has great gain with lower risk. And also remember the magic number, 2%. 2% is a very robust number. It's recommended by Thorpe, Professor Thorpe, and he did extensive testing. He said, this is a safe number. And I also believe this is a safe number for us. Okay, thank you very much. See you next time.